So I'd like to welcome all of you who are on the call. And yesterday we did distribute a question. At least Mr. Nkunguru was alert to immediately check it before I switched off my gadgets. He was late to identify that the question was the wrong one that I'd sent through. And I think I corrected it and you all got the right question, eh? Which was a P4 question, isn't it?
Yes.
Yes, we got the right question.
Yeah, it was nice that it was immediately identified. Okay, so this question today, why have we brought it? The question has got a number of items such as exam techniques that you can use on a 50-mark question. But the reason why we brought it specifically today is the overseas investment. And somebody had raised the question. The question was, these questions are too long, Mr. Piri. How can you try to do them quickly in the exam? What are some of the techniques? What are some of the techniques? So, an investment appraisal question requires a format, and then basically it's a table format. So to answer that question, how we can cut on the time is moving into this question with a format. You move in with a format where you already have an idea of the cash flows. And when you go into the question, you just tabulate your cash flows. Secondly, we should have done one or two similar questions and you have understood them and you have mastered them. So in the exam, it's not the time to go and figure out the format. By practicing questions, you're going to notice that investment appraisal questions, by and large, are similar in terms of the cash flows. An overseas question, the cash flows that you expect are quite similar. So what are some of the typical cash flows that you expect in such a question? What is it that you can reasonably expect that whenever there's an investment appraisal question, there's something that is going to come up? So let's discuss the format. We want to address that question. How quickly can you work out the question? So a typical investment appraisal question has got the following cash flows. So as you start the question, you want to anticipate your cash flows. By and large, the cash flows that you expect are those that are there in any appraisal question. So an advanced investment appraisal question from experienced requires a table format, and in that table there's the usual. And our examiner, we have known them that we normally go up to year 4. Our cash inflows will come from sales. Then we have known that the examiner likes the variable costs, the examiner likes the fixed costs, but also there are some special cash flows, which include the component from the head office being charged onto the project. Component from head office. If the examiner wants to go far, he can also say that there are some royalties that you have to pay at the head office, or some management fees you have to pay. If I was doing an overseas investment question, I'll anticipate those items. This is normal, that's normal, that's normal, but I'll be on the lookout for that. So in the question that you did these head office items come up? The question that you read through, we asked you to read through the question. Did the head office items come up?
Yes, we have the right in the question.
Yes. So this is how we know these questions, where you read the questions overseas, you start anticipating and you start providing for these items. Okay. After you have done that, what is the next item that you want to be on the lookout for? From there, you want to check the usual items, the tax allowed depreciation. So you want that item, you want the working capital. So you want those items. And also you want the asset cost. In almost all questions, these will come up. Then from there, you want an exchange rate so that you can convert your foreign cash flows. So by and large, in terms of cash flows, these are the major cash flows that you'll be looking for. And I always say that as you read the question, you start tabulating these. As you read through, you start tabulating these. You start putting the descriptions. And if you think some of them are very easy, there's no computation, like the asset cost, you put it in straight. So any item that has been given, even put it in straight. And that's the approach that we're going to take. Describing all the items, and these items are typical. Okay, so with that in mind now, we are going to go through the question and pick up the items, and then we do the descriptions and slot in the figures. That is what we are going to do. So let's pick up your question. So your question is here now. Let's pick up the question together. So now we know what cash flows we are looking for. So let's do a question debrief. Why? Whose currency is it? Why rand? We just call it the rand. So already there's an issue here. They're giving us the domestic currency. Has faced extreme difficult economic challenges in the past 25 years because of some questionable economic policies and political decisions made by its previous governments. Although white population is generally poor, its people are nevertheless well educated and they're also ambitious. Just over 3 years ago, a new government took office and since then it has imposed a number of strict monetary and physical controls, some economic terms there, including annual corporate tax of 40%, in attempts to bring Y out of difficulties. As a result, the annual rate of inflation has fallen rapidly from a high of 65, that's very high, to 33. These strict monetary and fiscal controls have made Y government popular in large cities and towns, but less popular in rural areas which seem to have suffered disproportionately from the strict monetary and fiscal controls. It's expected that annual inflation, this is annual inflation, will continue to fall in the coming years as follows. Now, this brings about a complication. Year one cash flows have to be inflated by 22%, year two 14.7, and 9.8. This is an area for concern because normally inflation rates are flat throughout the year or throughout the project duration, but this one is causing us a problem. So you want to tell yourself that when I'm inflating, I want to be very careful. I should keep my eyes open. I must keep my eyes really open. That's lesson one there. Okay. Let's move. Why government has decided to continue the progress made so far by encouraging foreign direct investment into the country. Recent government representatives held trade shows international and offered businesses a number of concessions, including, now, there's information for you here. What is the information? Zero corp tax in the first 2 years. So year 1 and 2, there's no tax. An opportunity to carry forward tax losses, there's tax losses. So already we are going to talk about what is the best formatting. When there's a mention of tax loss, what is the best formatting? And what you notice is that what you do in one question on tax losses, do it on the other questions as well. The working that you're going to do here, each time you read the question and they say there's a tax loss being carried forward, just say, I know my format. I've already, and I'm not changing my format. The government representatives also promised international companies investing in Y prime locations. Okay. For today, we're not so much interested in these promises, no. For today, our focus is on how can you quickly sort out the question on overseas investment. So let's talk about I company, a large listed company based in the USA. With the US dollar as its currency, so now the foreign cash flow issue is starting, isn't it? The foreign cash flow issue is starting. What do you think? So we have the company that we're looking at is based in the USA and the currency is US dollar. Manufactures high-tech diagnostic components for machinery which it exports worldwide. After attending one of the trade shows, I company is considering setting up a subsidiary, setting up an assembly plant in Y, where parts would be sent and assembled into a specific type of component which is currently being assembled in the USA. Once assembled, the component will be exported directly to companies based in the EU. The export will be invoiced in euro. It's very interesting. Why is in the country where they use USD? They're going to invest in a country where they use Y rand. They're going to sell this to a place where they use euros. Quite an interesting scenario. 3 currencies. So we need to realize that sales are not in Y rand. The sales, the revenues will come in euros. It is assumed that the project will last for 4 years. Now that's what we need there. So in terms of a description, 4 years. The project requires investment of 21 million. So land and buildings. Remember the figures we are talking about? That for some figures they are so straightforward. We don't want to. Those figures are so straightforward. So we have a straightforward figure here. 21 million land and building. 18,000 million in machinery. Okay. And 9.6 in working capital. Working capital will need to be increased annually at the start of each of the next 3 years by Y's inflation rate. We have seen those inflation rate there. So this figure has to be inflated. It's assumed that this will be released at the end of the project's life. So full information on working capital is here. It can be assumed that the assembly plant can be built very quickly and production started almost immediately. This is because the basic facilities and infrastructure are already in place as the plant will be built on the premises and grounds of the school. The school is ideally located near the main highway and rail line. As a result, the school will close and the children currently studying there will be located to other schools in the city. The government has kindly agreed to provide free buses to take the children to these schools for a period of 6 months to give parents time to arrange appropriate transport in the future for their children. Those are other issues that must be commented later. For now, for the purpose of our lecture, I'm not interested in that. Our interest starts. The current selling price of each component is 700 euros, and this price is likely to increase by the average EU rate of inflation from year 1 onwards. Now remember the question that we did, the Fubuki question. Do you remember the Fubuki question? Fubuki question, inflation was starting from year 2. But say this selling price is 700 in current selling prices, meaning today. This is today. In other words, this is year 0. And then there's going to be inflation from year 1 itself. We need to inflate this figure. So that gives an idea of some of the weightings. The number of components to be sold are, these are thousands. There's 150, 480, 730, and 360. So that gives an idea. The parts needed to assemble into components in Y will be sent from the USA. By amount at a cost of 200 per component. So we'll send them, from which I would currently earn a pre-tax contribution of 40 per component. So there's a component coming. However, I feel that it can negotiate with the government and increase the transfer price to 280. So we can increase this by 200. In other words, the contribution now will be 40 plus the increase, which is 80. So the contribution now will be 120. The variable cost relating to assembly. So now they're giving us information about the variable cost. So we have seen the sales, we have seen the component. Those items we have seen. We now move to the variable costs. The variable costs, which are back at Toma 15,960. The annual fixed costs are 46. All these costs, wherever incurred, are expected to increase by the country's annual inflation every year from year 1. So this component will go up by inflation. Variable costs will go up by inflation. Fixed costs will go up by inflation. Which inflation? Respective countries. I pays corp tax at 20% in the USA. The tax in both USA and Y is payable in the year that the tax liability arises. A bilateral tax treaty exists between Y and US. Tax allowable depreciation 25% on the machinery on straight line basis. So you've got your tax allowable depreciation 25% on machinery only, and the format is straight line. Okay. In the USA, the tax is 20%. And a bilateral tax treaty means that when your cash flows land in the USA, when you bring your cash flows in the USA, we recognize that you have already paid the tax. A bilateral tax treaty means that we recognize all the tax suffered. So the tax that you have paid in Y, we take it that it's been paid already. And if you have paid more tax, there's no more additional tax to pay. So for instance, Y is charging their tax at what? 40%. So you have already suffered 40%, 20% is small. So there's no additional tax in the US. That's the meaning of the additional tax treaty. So there's no additional tax because you have already suffered the higher tax. Then other expenses.
Mr. Piri, sorry.
Yes, please.
The 40% tax is based in Ireland. Then the 20 is based in the USA. Now, my thinking is that because the 40% tax is quite high in Ireland and the 20% tax is lower in the other country, mean that they have to pay the difference. Now, your explanation is that Ireland has already paid suffered the tax of 40%. I don't know if you can clarify that one.
So, the company has invested or expects to invest in Y. And there they are going to be, the first 2 years is nothing, that they're going to pay tax at 40%. What the tax treaty does is, it simply recognizes or gives credit for the tax you have already paid. A bilateral tax treaty recognizes the tax already paid.
Okay.
So it recognizes the tax paid. So here they will say, look, you have already paid 40%, that's enough. As our tax is 20%. But if our tax was 50%, would have said out of the 50, you have only paid what? 40%. So we're going to charge you the 10% that you didn't pay. You get it? Sankunguru?
Yes, but here, what I want to understand is that Ireland is the host country. And being the host country, that's where most of the transactions will take place. And meaning that this company pays tax, the companies in Ireland or whatever pay tax at 40%.
Yes, yes.
Then this Imon is paying tax at 20%.
They're coming from a country where the tax is 20%.
Yes, so I mean that they are paying lower tax.
In the USA, the tax is low.
Okay.
But they have made the decision to go and invest there, where they're being hammered 40%. They have got good reasons why they want to pay that high tax. So they're going to pay a very high tax, but maybe the revenues are very good as well. But they can't claim the tax they have paid there. No, they have paid 40%. Here, all we say is that there's no extra tax. Our tax rates are only 20%. So what you have paid, that's it. Us, there's no additional tax. Zero additional tax. But if our tax in the USA were 50%, would have said, you have only paid 40%, there's still a 10%. So we'll charge you a 10% in the USA. So that we make it 50. What you have paid plus what you didn't pay should take us to the 50.
So meaning that they are going to pay the difference of 20%
of 10%, of 10. Remember, they have paid 40 already. They have already paid the 40. In the USA, we've made an assumption that the taxes are 50%. So they say, out of the 50, I've already paid the 40. We only pay the difference, 10. So what you paid overseas 40, plus now the difference, so that it takes you to the US tax of 50%. But in this case, there's no extra tax because You have already paid your tax in full anyway.
Or bilateral treaty recognizes the tax already paid. Okay, thanks.
You won't be charged again. Is that okay?
Okay, that's fine.
All right. So let's, so we've got our tax issues there. Is there another expense? Yes. I will expect annual royalties from the assembly plant. So the normal annual royalty is 20, but I feel that it can negotiate with the government and increase the royalty fee by 80%. Once agreed, this fee will not be subject to any inflationary increase in the project's 4 years period. If I decide to invest in an assembly plant in one, its exports from US to EU will fall and to incur redundant concerns out. After-tax cash flows reduced by the following amounts. So there's the opportunity cost. The company is suffering this opportunity cost. Our cash flows are reducing by this amount. So we are suffering these back at home. So this project is creating an opportunity cost back at home. So we need to capture this. It's the relevant cost. It's a relevant cost that you must capture. So we'll capture that. I normally use a cost of capital of 9% to assess the new project. However, the FD suggests that I should use a project-specific discount rate of 4%. So they've already done all the gearing and de-gearing, and they say you must use 12%. They've already done the gearing and de-gearing. So they say you use 12%. Now we have seen that there are 3 currencies involved, didn't we? We saw there are 3 currencies involved, isn't it? That is why we're not surprised that there are how many exchange rates? 3 of them. We've got the euros and the dollar, Y-Rand and the euro, Y-Rand and the dollar. There are 3 currencies. The focus future rates based on expected inflation differentials, they are given Y-Rand on a single dollar. So this is Y-Rand. In a similar way, Y-Rand on the euro, that has been given. So in this particular case, there's no need of you estimating on forward rates. They have been given. But I have an exercise for you. The exercise I have for you is, I want you, as part of your personal study before the next class, you must go and calculate these. So you go and prove that these are correct. So you're going to take, like this one is Y-Rand on a dollar. You're going to take this one. This is your spot rate. From this, you're going to calculate the what? The forward rates in year 1, year 2, year 3, and year 4. What are you going to use? Inflation rate differential. In a similar way, you're going to get these ones. Y-Rand on a euro. Y-Rand on a euro, again, you're going to get year 1, year 2, year 3, year 4. We just want to know that, to be sure that all of you can move from what? What? Want to make sure that all of you can move, because it's not all the time that the forward rates will be given. Here the examiner was very friendly. He gave you the forward rates. Very, very friendly examiner. So all you need now is just to inflate the cash flows, that's all. That's the work that we have. And with the use of the computer, it's much easier. With the use of the computer, it's a lot easier. It's a lot easier. Okay. So let us now go. But A, not for today. But B1, prepare a report which evaluates the financial acceptability in the assembly plant. Financial acceptability. So that is what we want to focus on. Yeah. Now let's go. Let's come here. As usual, I have prepared a worksheet here. I've prepared the worksheet here. So here is the worksheet I've prepared. Year 1 to 4, the sales, the variable cost, the component, the fixed cost, the royalties, the cash flow before tax. I've decided to keep tax in a working. Then there's working capital. Then there's asset. There's cash flow after tax. There's the exchange rate. Then after exchange rate, we convert all these cash flows. Once we convert them, they're in US dollars. Then at the head office, there are some relevant costs, including the royalties, contribution on the components, and the opportunity cost. I've also put a line for additional local tax. Although there's nothing here, I've put a line for it. We've got the net flow, discount rate, and the PVs. So I want to talk about the strategy to overseas investment questions. So this is a strategy. You describe, as you read through, you identify the cash flows, come here and list all of them, like what we have done. That's my recommendation. It will help us a lot. Let's just keep this recording will be too long. Let's just break it.